In this session, we are going to look at the tax implications for companies which are close. Close company rules exist to prevent shareholders and directors of close companies from using those companies as an extension to their own private banking facilities without paying any tax. Rules exist with regard to loans to participators, benefits paid to participators, and other extractions of value by participators. In this lecture, we are going to look at the loans to participator rules, which we expand on in part 2, when we also look at the benefits to participators and other extractions of value. Every time a close company makes a loan to a participator of the company, Section 455 CTA 2010 applies to charge the close company penalty tax. The provisions of Section 455 CTA 2010 also apply where the loan is made by a close company to a partnership, in which one of the partners is a participator or an associate of a participator, or to a trust of which a participator or associate is an actual or potential beneficiary. These rules catch in particular loans from a close company to any partnership or limited liability partnership, LLP, of which it is typically a partner or member. If any of the individual partners is also a participator of the close company, the company will be subject to Section 455 tax on the amount of the loan. The rules also catch loans to employee benefit trusts, EBTs, where beneficiaries, actual or potential, are also participators in the company. Close companies which are not liable to pay their corporation tax by instalments will be required to pay Section 455 tax on their normal due date, i.e. 9 months and 1 day following the end of the accounting period. For larger close companies, Section 455 tax is added to the amount of tax due by instalments. The tax is calculated as 32.5% of the loan and is payable by the company. This rate is the same as the dividend upper rate. The amount of the loan is taken as the lower of the amount outstanding on A, the last day of the accounting period, or B, the normal due date. For example, Jack borrowed £20,000 from Vine Limited, a small close company, on 30 September 2020. He will repay £10,000 on 30 September 2021 and then £5,000 each on 30 September 2022 and 2023 respectively. Vine Limited has a 31 December accounting date. We will show how much tax is due under Section 455 CTA 2010 and when it is payable. The loan advanced on 30 September 2020, which is during the company's year ended 31st of December 2020. The rate of Section 455 tax is 32.5%. The amount outstanding at the end of the accounting period, i.e. at 31 December 2020, is £20,000. The amount outstanding at the due date of payment for corporation tax, i.e. at 1st of October 2021, is £10,000, because £10,000 was repaid in September 2021. Therefore, the Section 455 tax due on 1st of October 2021 is £10,000 at 32.5%, being £3,250. Let us now look at the rules relating to the repayment of this Section 455 tax. Where the loan is either repaid by the participator or released or written off, the participator being released from any further repayments, tax previously paid under Section 455 will be refunded back to the company. The refund is made by reducing the company's tax liability for the accounting period in which the loan is repaid, released or written off. As most close companies are small, this will normally be 9 months and 1 day from the end of the accounting period in which the repayment or release of the loan is made. No relief from Section 455 tax is due if loans totalling £5,000 or more are repaid and then £5,000 or more is then re-borrowed from the company within 30 days. This is to prevent taxpayers avoiding the Section 455 charge by repaying loans immediately before the due date for payment and borrowing the money back as soon as that date has passed. In addition, if immediately before a repayment there is a loan outstanding of £15,000 or more from the company, and any time after the repayment the participator borrows any amount and at the time of the repayment there are arrangements or an intention to draw further advances of money from the company, the relief will be denied, even if the loan is not redrawn within 30 days of the repayment. Let us look in more detail at loan write-offs and releases. If a company writes off or releases a loan to a participator, as we saw earlier, the company will receive a repayment of the Section 455 tax. The participator will be treated as receiving a dividend equal to the amount of the loan written off or released. The date of receipt of the dividend will be taken as the date of the loan write-off or release. An individual will pay any tax due on this dividend via self-assessment. This treatment also applies if the participator is also an employee. The write-off or release is still treated as a dividend and not employment income. However, it is not strictly a dividend from the company's point of view. The release or writing off gives rise to a debit under the loan relationship rules, and this is not an allowable deduction for tax purposes. Where the participator or associate is an employee, the loan released or written off is treated as earnings from employment for NIC purposes. It will therefore be subject to Class 1 NIC, so the employee will pay 12% or 2% of the amount released or written off, depending on the level of their employment income. And the company will pay Class 1 NIC at 13.8%. The NIC paid by the company is a deductible expense for the company. Let us look at an illustration. Heppel Limited, a small close company, advanced £15,000 to Fred, who is a director and shareholder, on the 31st of December 2018. On the 31st of December 2021, Fred repaid £5,000 and Heppel Limited wrote off a further £9,000. Heppel Limited has a 31st of March year end. Let us first look at the Section 455 position for Heppel Limited. The loan is advanced on the 31st of December 2018, which is in the company's accounting period ended 31st of March 2019. Section 455 tax was due 9 months and 1 day later, which is on the 1st of January 2020. The Section 455 tax is 32.5% of the loan, which is £4,875. This tax is refunded when the loan is either written off or repaid, and a total of £14,000 is repaid and written off from the loan on the 31st of December 2021, which is during the company's year ended 31st of March 2022. Any refund is made 9 months and 1 day later on the 1st of January 2023, which will be the combined amount of the loan repaid and written off of £14,000 at 32.5%, which is £4,550. The write-off will not be an allowable deduction for corporation tax purposes. As Fred is a director, the £9,000 will be subject to Class 1 NIC at 13.8%, being £1,242. This is deductible by the company. Continuing with this illustration, let's look at the situation for Fred. Fred is deemed to receive a dividend of £9,000 on the 31st of December 2021, which is in tax year 2021-22. Assuming that Fred is an additional rate taxpayer and has received other dividend income in the year which has used up his £2,000 dividend allowance, he will be taxed on that dividend. Tax is charged at the additional rate on dividends of 38.1% as Fred is an additional rate taxpayer, leaving us with additional rate tax due of £3,429. This will be due from Fred on the 31st of January 2023. As Fred is a director, the £9,000 will be subject to Class 1 NIC at 12% or 2%, depending on the level of his other employment income. That concludes the first part of this lecture on close companies.